This week we'll cover chapter 21. It's on cost volume profit analysis or CVP analysis. As a reminder, please fill out and submit classwork 21 for your attendance grade. We're going to begin by discussing costs. This is pretty similar to what we covered in chapter 18 when we discussed direct materials, direct labor, and factory overhead. Cost behavior is the study of how specific costs respond to changes in levels of business activity. Business activity can mean many things depending on the type of business. For example, it could be units produced in a manufacturing company. In a hotel, the business activity could be rooms occupied. For retail businesses, it could be the number of sales made. Here at OCC, our business activity could be classes taught or even students enrolled. CVP analysis is part of managerial accounting. The purpose is to help internal users make predictions and business decisions such as how many units must we sell to break even? How much does income increase if we install a new machine to reduce labor cost? What is the change in income if selling prices decline, yet sales volume increases? Or it could be vice versa. How will income change if we change the sales mix of our products or services? What sales volume is needed to earn a target income? And many other questions like this. We will begin by discussing the different types of costs. The first cost we're going to discuss is fixed costs. Fixed costs are costs that stay the same regardless of the business activity. That means no matter how slow or busy the company is, this expense would stay the same. That is why this graph shows a flat line. We will be using this graph throughout this chapter. The horizontal line at the bottom is the amount of units produced or whatever the business activity is. Producing units is just one example. The vertical line on the left-hand side is the cost of the expense. In this case, regardless of business activity, whether it's at zero or it's really high, the cost is going to stay the same. That's where the flat line comes into play. Now the flat line is the total overall cost. If we break this down on a per unit basis, it will vary inversely with activity. A per unit basis means per business activity. I'll give you examples of how this works in a moment. Think of some examples of fixed costs you have. For example, my mortgage is a fixed cost. Regardless if I'm home every day or if I'm out on vacation for the whole month, I still have to pay the same amount of mortgage. Regardless if I use the house a lot or a little, it doesn't change. Overall, it's still fixed. Another example is my car insurance. I haven't driven at all in the past several weeks, yet I still have to pay the same amount of car insurance. For you, you might have a Netflix account. Regardless if you watch Netflix all day, every day, or you haven't looked at it once this month, you still have to make the same payment. These are fixed costs. Some examples of fixed costs that businesses have could be property taxes, insurance, rent, depreciation on buildings and equipment. These expenses that a business has would stay the same regardless if they had a lot of activity in the business or none at all. Regardless if it was a slow month or a busy month, this would stay the same. Let's look at an example for this. Let's say I pay rent of $1,000 per month for my facility. In my facility, I make shirts. If I made 0 shirts for the month, my cost would still be $1,000. Let's say I made 1,000 shirts. My cost would still be $1,000. That's why the line here is flat. It doesn't change regardless if I go up and up in the amount of units produced, that cost is flat. Now let's relate it to on a per unit basis. Let's say I only made 1 shirt for the whole month. I still had to pay the $1,000. How much of this $1,000 went to that shirt? Well, that shirt cost me $1,000 to make because that's what I had to pay for the rent. Let's say I made 1,000 shirts. How do I associate this cost with those 1,000 shirts? Well, if I made 1,000 shirts and rent cost me $1,000, then I can allocate that by saying it cost me $1 to make each shirt. That's why on a per unit basis, it's more of a curved line. The more we make, the more of the cost we can allocate. When we're looking at these graphs, we're always looking at what's called the relevant range. This is the range of activity over which a company expects to operate during a year. We're usually looking at a relevant range of maybe 40 to 80% capacity. If it goes below 40, then we might start laying people off, or if it goes too high, we might have to start to build more facilities or open up more locations. So we're really looking at this like optimal range right in the middle. The next type of cost we're going to talk about is variable costs. Variable costs are the exact opposite of fixed costs. These costs do vary in regards to business activity. This means the more our business activity increases, the more the cost will also increase. It will also increase proportionately. That's a key word here. Using the same example of making shirts, let's say we were able to double the amount of shirts to be produced. What costs will also double? Our direct materials would double because we now need 2 times the amount of fabric. Our direct labor will also double because we need to pay employees to produce twice the amount of shirts. These are all variable costs. One of your variable costs could be gas. The more you drive, the more gas you spend. And on a side note, we're only looking at how cost responds to activity levels, not outside factors. Obviously, gas prices change every day, but that's not because of us. That has to do with the outside factors and economic activities. But if I double the amount of miles I drive, I will also double the amount of gas I spend. On a per unit basis, these costs stay the same. Once again, we're not looking at outside factors. We are doing this for a specific point in time. If gas costs $2 a gallon, then regardless of how many miles I drive, each gallon of gas will still cost me $2. If I'm making shirts, my overall cost will increase, but each shirt itself will cost the same amount to make. On a per unit basis, it'll be the same. I still spend the same amount of labor and the same amount of material on each shirt. Regardless if I make 1 shirt or 1,000 shirts, I'm still spending the same amount on each shirt individually. Overall, the more I make, the more these costs will go up. Our final cost is a mixed cost. And you guessed it, it's a combination of both fixed and variable costs. One example I always like to use is renting a U-Haul. For anyone that has ever rented one, you know that you are charged a flat rental rate plus a per mile rate. The flat rate, you would be charged regardless of how many miles you drive. Therefore, that would be a fixed cost. You're also being charged per mile. The more miles you drive, the more this expense will increase. This would be the variable portion. You are charged one fee, which is the mixed cost, a combination of the two. One example that businesses have a lot of, and you also personally, would be utilities. Your electricity bill, your gas bill, heat bill. You're usually charged a flat service rate just for having the service with them, plus your usage is added on top of that. Your flat service fee would be the fixed cost. Then the more you use it, the higher that goes. That would be your variable cost. You're charged one cost, which is the mixed cost. You'll know it's a mixed cost because the cost will increase with business activity, but not proportionally like variable costs. When companies do have a mixed cost, they will need to determine what part is fixed and which part is variable. This is because when we do our analysis, we need to know those two amounts and group all the fixed together and group all of the variable costs together. In order to separate and mix costs, we will use the high-low method, which we'll be discussing soon. This graph shows the straight line as the fixed cost, and the variable cost gets added on top of that. The total would be the mixed cost, which would be the fixed cost plus the variable portion will give us the total cost. And like I said, we'll be using the high-low method to figure out the variable amount and to figure out what the fixed amount is. Before we learn the high-low method, let's do our first practice problem. This is number 1 on your classwork. Make sure you're filling this in with me because you need to turn this in. Number 1, identify whether each of the following is best described as a fixed, variable, or mixed cost. In this example, it looks like we're making sporting equipment. A, rubber used to manufacture athletic shoes. Now, I always ask myself, if the business activity increases, if it doubles, will this cost also double? Think about this for a moment. We're making shoes and we need rubber on each of the shoes. Now, if we make twice as many shoes, do we need twice as much rubber? The answer is yes. Therefore, this would be a variable cost. B, maintenance of factory machinery. This one's a little more tough to figure out because there's not one exact answer. What do you think it would be? It really depends on how the company is set up. Do they only call maintenance people in when something breaks, or do they always have someone on staff? We're going to say that maintenance is probably going to be mixed, but depending on how the company is set up, it could be one of the other ones. The rest of them are pretty straightforward. C, packaging expense. We do have to package the shoes. Let's say we put them into a shoe box. Now, if we make twice as many shoes, do we need twice as many boxes? Yes, that would be a variable cost. D, wages of an assembly line worker paid on the basis of acceptable units produced. This is what we're paying someone to make the shoes. If we double the amount of shoes, do we have to double the amount of wages paid to our assembly line workers? We do. Our direct labor expense will increase. It will double because we need to pay them for double the amount of hours. This would be a variable cost. Factory supervisor salary. Do you all understand how salary works? This is different from wages. Wages is on a per hour basis. Salary is one amount for the whole year. Regardless of how many hours are worked, salary would stay the same. For example, I'm on a salary. If I work overtime or if I work less hours, I still get paid the same thing. What cost do you think this would be? This would be a fixed cost because regardless of how many shoes we're making, whether we double or not, the manager or supervisor's salary would still stay the same. F, taxes on factory building. This would be like the property taxes. It's just like I have property taxes on my house. Now, if we make twice as many shoes, will our property taxes also double? No, that's a fixed cost. This will stay the same regardless. Just think the company is not sending information to the New Jersey government to say, hey, this is how many I made this month, please charge me more money. That's not how it works. You get charged one amount, and regardless of what you do in that space, it's that amount. G, depreciation expense of warehouse. We'll depreciate the warehouse each year. Remember, we're just writing off the cost of us paying for the warehouse. And usually we use the straight line basis. What kind of cost do you think this would be? It would be fixed. Regardless of our amount of units that we're making, we would just write off the same amount of depreciation each year. Okay, we're now going to discuss the high-low method. As a reminder, the high-low method is used for mixed costs. We will use this method to separate the mixed cost into its fixed amount and variable amount. We will use information from the highest and or the lowest levels of activity to determine this. The first step is to determine the variable cost per unit. We will have several months worth of information. We will know the business activity levels and the total mixed costs. To find this number, we will follow this formula. We will look through the data and find the time periods with the highest cost and activity and the time periods with the lowest cost and activity. We will take the highest mixed cost and subtract the lowest mixed cost from it. We will then take the highest level of business activity and subtract the lowest level of business activity. We will then divide both these numbers. To reiterate, it's the highest minus the lowest cost divided by the highest minus the lowest activity level. Step 2 is to determine the total fixed costs. The formula for this is a little bit more complicated than from step 1. You can use either the highest numbers or the lowest numbers. However, my advice is to do both. You will get the same answer for both of them. And if your answers do match for both, then you know you did it correctly. To use this formula, you either take the highest or the lowest cost, then subtract the multiplication of the variable cost per unit times either the highest or lowest activity level. The variable cost per unit is the answer you got from step 1. We'll do an example together next. This is not the classwork problem. That's something we'll be going over on the next slide. First, I just want to show you an example of how to do this. We have 4 months worth of data. We have the total units, which would be the business activity. In this case, we also have the total costs. In step 1, we want to divide the highest minus the lowest cost by the highest minus the lowest activity. Look at the cost column, which is the last column. What are the highest and lowest numbers here? The highest number is 59,000 and the lowest number is 38,000. We will subtract these to find the numerator in step 1. 59,000 minus 38,000 equals 21,000. Next, we will subtract the highest and lowest units, which is the business activity. What are they? The highest units is 3,000 and the lowest is 1,250. We will subtract these two numbers to find the denominator. 3,000 minus 1,250 equals 1,750. Now we will divide these two numbers that we just calculated. 21,000 divided by 1,750 equals, you should get 12, which is $12 per unit. This is my variable cost per unit, meaning each unit extra will cost another $12. Step 2 can be done in 2 ways, the high or low way. I'll show you both. First, you want to take the highest or the lowest cost, which would be the 59,000 and the 38,000, right here. Subtract the variable cost per unit. We got this right here in step 1, times the units, the highest, which is 3,000, or the lowest, which is 1,250. You should do the multiplication first, get that answer, and then subtract that from the total cost. 59,000 minus the multiplication of $12 times 3,000, or 38,000 minus the multiplication of 12 times 1,250. You should get the same answer for both, and it's pretty easy to do, so I do recommend doing both. You would get $23,000 for both of them. This is how we know we did it correctly, and this would be my fixed cost. Now it's your turn to try this with the classwork example. This is number 2. The following information is available for a company's maintenance cost over the last 7 months. We'll use the high-low method here. Remember, you do not need to use all these months, only the highest and lowest. Ideally, I would like you to pause this video and try this problem on your own to see if you understand. You should do this now. Look through the data and find the highest and lowest months. The highest month is November. The lowest month is December. We won't need any of the other months to do this calculation. First, we need to find the variable cost per hour. This would be the highest minus the lowest cost, highest cost minus the lowest cost, divide by the highest activity level minus the lowest activity level. We would do 8,100 minus 3,600, which equals 4,500. We would divide this by 24 minus 6, which equals 18. 4,500 divided by 18 is 250. So our variable cost would be $250 per hour. Next, we have to find our total fixed cost. Remember, there's 2 ways to do this. I'll do the high way first. We take our highest cost, which is 8,100, minus the variable cost per unit from step 1 times the highest activity level, which would be 24. Remember to multiply this first. 250 minus times 24 would give you 6,000. 8,100 minus 6,000 equals 2,100. This is what I got as the total fixed cost, but let's try the low way to see if we get the same answer. I will take the lowest cost, which is 3,600, minus the variable cost per unit from step 1, 250, times the lowest activity, which is 6. I'll multiply 250 by 6 first, which gives me 1,500. 3,600 minus 1,500 is 2,100. And that might be hard to see, but we get the same answer. 2,100 would be our total fixed cost. And this is the high-low method. This is how we separate the variable portion from the fixed portion.